In the next few minutes, you're going to understand investing more than most people do over their lifetime. If you're new to investing, welcome. Hi, I'm Alice. I'm a chartered accountant, a finance educator, and I love teaching you all about investing, money management, and all things building wealth, no matter what your income is. Because successful investing is not about being smarter, quicker, or luckier. It's about applying principles consistently. So let's break it down. Number one, what investing actually is. At its core, investing is actually really simple. The world has made it seem so complicated and like it's just for men and like it's just for old men that have a lot of money. But the truth is, you don't invest when you're rich. You invest to be rich. You're literally using your money to grow so that it can buy you freedom over time. It's like what you do with savings so that it grows exponentially, but investing just speeds it up way quicker. Your goal as an investor is not to beat the market. It's to increase your money in line with inflation. Or better yet, increase it more than inflation. It's not about being right all the time. It's not about impressing people. It's taking risks that you can actually live with that sound way riskier than they are. If you let your investments sleep at night, you rarely touch them, and they feed your long-term goals, then you're doing it right. Chapter 2. The power of time. The power of time is your secret weapon. It is the most powerful force in investing. Compound interest, time in the market. Albert Einstein called compound interest the eighth wonder of the world, and he's not wrong. It's not very intuitive, but thanks to this compound growth, small consistent investments can grow to be a large amount over time. For example, if you start with zero and you contribute $200 per month, not too much, right? And you retire in 35 years. Let's assume an average interest rate of 8%. To be honest, it could be higher. The last few years, it's been over 20%. You would have $413,000 by the time you retire. Now, let's say, actually, we want to retire in 40 years, and I'm going to be a bit better. I'm going to put 300 in. Now, we might think that 400 is going to go to something like 5 or 600, but that extra 5 years and that extra 100 per month is going to significantly increase that 400,000. Let's calculate. Whoa, so we've nearly got $1 million. $932,000. That's by saving only $300 a month. And remember, you're going to get pay rises, so you're going to be able to contribute even more and even more and even more. There are many ways that you can invest. You're probably already investing right now in workplace pensions or 401k in the US, and a lot of people will get workplace matches, so it's free money. And this is going to be compounding, as I just showed you. If we want even more when we retire, or even more before then, we need to invest separately outside of pensions. We can do that through tax-advantaged accounts, like Roth IRAs or ISAs in the UK. Most countries don't have those products, so we just want to open an investment account on eToro, Vanguard, a platform like this, and put in money. Nobody knows which stock sector will win next. That's why diversification is really important. And this is why index funds are really important. An index fund is essentially, think of a bag of Skittles, and you have different colors of Skittles, and you have a lot of different Skittles. The bag of Skittles is the index fund. The individual Skittle inside is an individual stock. So the S&P 500, the top 500 companies in the US, is like a bag with 500 companies. You're just buying a portion of that bag rather than buying in each individual company. It's easier and it's actually cheaper because there's not that many fees. You're only paying a small fee to invest in the index fund and not a fee to invest in each individual stock. My personal rule of thumb looks like 80% index funds, 10% cash and gold, and 10% fun money, individual stocks like crypto or Tesla or Apple, etc. This approach gives you growth, stability, but it also has a good risk balance. If you are older, then you might want to decrease the individual stocks that you invest in, and you might want to put it all into index funds and bonds, which is a little more stable. You don't need to find the one perfect investment. You just need to avoid being wrong in a big way. So that's why index funds are the best. Dollar cost averaging, how to invest without stress. One of the best strategies for most people is dollar cost averaging. We don't have time to sit there and track up and down, up and down. Do we think it's going to go up? Do we think it's going to go down? Putting big lump sums in when we think it's at the lowest point, because we're not mind readers. We can't predict what's going on, and most of us are not experts. So this is why dollar cost averaging is the best method. Essentially, this means you fix investing an amount of money each month or every 2 weeks, whatever your regular schedule is. And that happens whether the market's up or whether the market is down. And this is why automating your investments is also a great idea. So I personally get paid every month, so I like to invest X dollars every single month. But if I got paid bi-weekly, I would most likely do that. Sometimes I do that. Sometimes I have it in cash in my investment account, and then every week or every 2 weeks, I will add to the index fund just to make sure that I am buying at different prices to level out my risk. Set it, automate it, forget it. Simple usually wins. Most investors underperform not because they don't know enough, but because they know too much. They chase trends, they're trying to time the market, they're constantly buying and selling. A simple, low cost, long-term approach is the best. Index funds, stick it in there. Over time, it will grow tremendously and it's extremely passive. Boring investing is boring, but it works. Now I want to talk about emotions, and emotions are the real enemy. The market will go up, the market will go down, and at some point it might feel uncomfortable. But do not panic sell. Don't touch it. The biggest mistakes happen when greed or fear take over. The most successful investment portfolios were people that forgot their passwords. If you want to be a successful investor like other successful investors, then you will not panic when the market falls. You will stick to your plan. X dollars every single month, whatever happens. And to be honest, the only time I like to defer from this rule is when the markets crash, because that is when stocks are on sale. I think it's always worth buying a little bit more if it's an index fund, not an individual stock, because you don't know if individual stocks are going to go back up. But you know, in the long term, the market's always going to go up over time. So buying at cheap prices is the best idea. If you remember nothing else, remember this: invest for the long term, diversify wisely, use dollar cost averaging, keep costs low, stay consistent, ignore the noise. Do this and you'll already be ahead of 90% of investors. You don't need any secret strategies. You need a plan and the discipline to stick with it. If this video helped clarify investing, consider liking it or sharing it with others if you think it would also help them. If there's any other videos that you want to see from me, maybe a step-by-step walkthrough of how to invest, let me know in the comments below and I will certainly do that for you in 2026. Thanks for watching and I'll see you next time.